The Big Beautiful Bill, no tax on overtime explained. For context, as of July 4th, the Big Beautiful Bill has officially been signed into law, and as part of that 897-page document was the highly publicized, highly anticipated no tax on overtime. But what does this actually mean for hourly workers? Well, you'll have to stick around and find out. Before we dive into the details, make sure to hit that follow button. First and foremost, this one is pretty self-explanatory. In order to qualify for this deduction, you'll have to be a non-exempt employee. Second, to qualify for the full deduction, you'll have to make less than $150,000 a year as an individual. After that point, depending on your modified adjusted gross income, the benefit will either be reduced or fully eliminated. If you make less than $150K a year and are a non-exempt employee, then for overtime, you'll qualify for that $12,500 deduction on your federal income taxes. To note, this does not reduce your state and local tax burden, and you'll still have to pay Social Security and Medicare on those dollars. Now, this is where things get tricky, so follow along here. This deduction only applies to the premium as required by FLSA, which means if you normally make $20 an hour and your overtime pay as required by FLSA is $30 an hour, the deduction only applies to the additional $10 an hour that you earn on that overtime pay. If you live in a state that requires more than FLSA, it does not apply above and beyond what is just required by FLSA. Finally, the last call out, and I think the most important that many don't realize, is that this is only a temporary tax break. It is set to phase out in 2028. After that point, we'll have to see where our next wave of politicians and legislation takes us.